that the weakness that we're seeing in equity markets in response to the jobs data is more of a valuation recalibration versus something that's more nefarious. A great rule to use is effectively if it is about positioning and valuations, it's typically a short and a shallower correction. If it's about growth expectations, it's a deeper, more protracted correction.
Jobs numbers came out on Friday. December non-farm payrolls increased by 256,000, much higher than the initial expectation of 155,000. The unemployment rate also fell to 4.1%. So how is the Fed likely going to respond to this economic data? And what's next for markets and economic growth? We'll talk about this with Cameron Dawson, CIO of Newedge Wealth. Happy New Year, Cameron. Good to see you again. Welcome back.
Good to see you too. Thank you so much for having me, David.
Cameron, markets are down. By markets, I mean the stock markets, in particular the S&P is down about 1.5%, and so is the NASDAQ. Why do you think the markets are reacting poorly to good economic data? Is good economic data once again bad news?
Well, we do think that in the long term or long run, good news is good news and bad news is bad news, meaning that you do want to see good economic data for the equity market to continue to do what it does. But there are periods when good news becomes bad news. And that is certainly a moment like today, where because we had this stronger than expected jobs market, it effectively pushed out all of the pricing for interest rate cuts from the Fed into the back half of the year. Yields spiked higher, and the end result is the equity market kind of took it on the chin. Even though this means that the US economy has no evidence of falling into a recession, which would be a far worse outcome for equities, but because we came into this year with such stretched valuations, it creates a very little bit of cushion to absorb these very high interest rates, which is just to say that we think that the weakness that we're seeing in equity markets in response to the jobs data is more of a valuation recalibration versus something that's more nefarious. A great rule to use is effectively if it is about positioning and valuations, it's typically a short and a shallower correction. If it's about growth expectations, it's a deeper, more protracted correction. The way you tell the difference between the two, we think, is you watch credit spreads. Look at credit spreads. If they start to widen out, that's when the market gets afraid about growth. But if they don't widen as the equity market's selling off, that just means that this is normal digestion of markets that had run too far too fast.
Fed officials are coming out and saying that perhaps this may be the end of rate cuts for now. We have Chicago Fed President Dawson saying that the latest jobs report is suggesting the labor market is stabilizing. He said that interest rates will be a fair bit lower over the next 12 to 18 months. As long as inflation doesn't move higher, it's a strong jobs report. He said it makes me comfortable that the job market is stabilizing at something like a full employment rate. Other members of the Fed are saying that rate cuts can probably wait, according to the Wall Street Journal. Is the Fed jumping to conclusions too fast, do you think, just given a few data points that came out in the last month and a half?
Well, we do know that they have been perpetually behind the curve and at times responding and getting whipsawed to things. If we go back to September, the phrase that paid in September was this one word, recalibration.
Yes.
Powell said it a bunch of times in that meeting, this idea that even though we weren't seeing a sharp deterioration in the labor market, yeah, we had seen some questionable labor data over the summer, but we weren't seeing this sharp deterioration in the labor market. But they were still cutting interest rates because they said, look, based on where inflation is, policy rates are restrictive, and we have room to bring rates or recalibrate rates back to a level that's closer to neutral. So that's what led people like Austin Goolsbee to come out and say, hey, even if we don't see a distinct weakening in the labor market, we could see, in quote, hundreds of basis points of cuts in order to get us to that neutral. Now, we've been thinking that neutral this cycle is higher than what the Fed has predicted and what markets were predicting up until recently, as you've seen the 10-year and the 30-year Treasury really shoot higher, which just suggests that there's some pricing of that higher neutral rate getting put in those long end yields. And so when we think about the Fed's reaction function, there is one important point to note. If you go back to the December summary economic projections, they did two things. They lowered the target for the employment rate and they raised the target for inflation. So we've been arguing over the last month or so that the recalibration phase of this Fed easing cycle is over, meaning that if they ease further, they will be easing for a reason. They will be easing because the job market is weaker than expected. But that December SEP is important because in some ways they just lowered the bar for what would be acceptable amount of easing in order to cut rates. By lowering that unemployment estimate, they effectively say, hey, if unemployment gets too far above this new lower bar, we'll be cutting. So we do think that recalibration phase is over, which means you have to see weaker unemployment data for the Fed to deliver those cuts. So we'd push back a little bit against Goolsbee effectively saying, if it all stays the same, we'll still be cutting. We're not so sure that that's going to be the case simply because inflation does remain sticky and not at their target.
So ultimately, the CME Fed Watch tool and market participants are reacting to this by pushing out the timeline for a cut. So no cuts are expected at the next meeting in 2 weeks. No cuts are expected in March. It isn't until June, Cameron, that we're starting to see more of a higher probability of even a 25 basis point cut. Do you agree with market expectations?
Well, first of all, you can call me Dawson because I've always wanted to be cool enough to be called by my last name. So one day I will be. Look, I would say that a lot can happen. Right now, if you were to extrapolate the data based on the current trends today, I would argue that market pricing is correct. But if you assume that maybe at some point between now and June, we have a weaker unemployment rate, we have a weak non-farm payrolls print, then all of a sudden we'll go from pricing in very few cuts, one cut over the course of 2025 into pricing in more cuts. And we know that that's going to happen because look at that happened in 2024 where we had this whipsaw. We started the year at 6.5. We got all the way up to just one cut and we ended with the equivalent of 4 cuts. So that whipsaw is likely to happen, which is why we think our conclusion for interest rates over the course of 2025 is that we remain in this very wide band like we were in 24. 2024 didn't really go anywhere. It just sideways chopped in a very volatile band. So if you're looking as a bond investor, you say, okay, when yields spike and bonds sell off, it's a good time to be a buyer. And when you see yields come in on growth fears, you probably want to be patient. So we think that wide range of 3.5% to 5%, that's not very helpful, but that wide range is likely going to persist in 2025.
And you've told me before that rate cuts could be restrictive for economic growth in some ways. And now that we're probably not getting as many rate cuts, can you maybe comment as to, first of all, what you meant by that in the past and whether or not things will be different in terms of policy restrictions and monetary liquidity conditions?
Yeah, this is the uniqueness of this cycle, which is a dynamic that we'd never seen before, which is that if you look at the net interest expense line in national aggregate data, for the first time ever, as the Fed was raising rates in 2022 and 23, 24, that you saw net interest expense actually fall and not rise. So every time it used to be that Fed raises rates, you see interest expense go up. And so people's cost of debt would move significantly higher. Their entire cost of debt would move significantly higher. And thus they'd pull back on spending, pull back on hiring, and you'd see the economy slow down. What we saw this last cycle was that as the Fed was raising rates, because of the dynamic of the ability for people to term out their debt through a decade and a half of quantitative easing, suppress long-term interest rates, that you actually saw people earn more on their cash than they were seeing their interest expense go up. And so that's that notion of, if you think about it from the consumer perspective, mostly the high income consumer who has been the key driving force behind this economic growth. If you look at household consumption forecasts, they started the year at under 1% for 2024. They ended the year at 3.5% for 2024. This is all thanks to the fact that the high income consumer, or not all thanks, but a good portion, is enjoying an incredible incredible wealth effect right now. You have soaring stock prices and their cash balances, which we know are 30% higher than they were prior to the pandemic, are earning big, huge returns because of these high interest rates. So one of the things that we floated out is that if you are a large corporation or a high income household, the Fed cutting rates significantly actually takes money out of your pocket because you're not as reliant on debt as low income households. You don't have the same kind of credit card debt where you're seeing interest rates spike in that area. So when we think about the progression forward, what we think is that you're actually starting to see that net interest expense start to turn higher. So the second derivative is turning, which means it's just falling less than it was. And that's a function of the fact that A, the Fed has cut rates a little bit, but B, you're also starting to see a refinancing cycle. A lot of the debt that was issued in 2020, 2021, when rates were so low, is starting to come due. It's up in 25, it's up a lot in 26, and even higher in 27, which is why we think that eventually these high rates will actually be restrictive, but it's just taking a lot longer because of those QE dynamics.
And so now that we don't have as many rate cuts anymore, how does this dynamic change?
Well, it certainly hurts small caps. And I think that that's a very interesting kind of microcosm for all of this, because if there's a poster child for a cohort of companies that do get hurt by higher interest rates, it's the Russell 2000, given the fact that you have high levels of no profitability within the Russell 2. You have much higher usage of floating rate debt, as well as much higher debt levels. And if you look over the last 2 years, consistently, Russell 2000 earnings have been cut just month after month after month. 2025 estimates for Russell 2 were cut 25% over the course of last year, which just means you cut your earnings power by a quarter, likely because a large dynamic is not the economy is weak, but because interest rates are so high and pressuring balance sheets. And so you saw this huge rally, though, not huge, but you saw a rally in small cap stocks that was all based on valuation multiple. If you reduce the likelihood that you're going to get interest rate cuts, those valuations start to come back in, and then maybe you see some more weakness within small caps.
If you just take a look at the Fed funds rate on a historical basis, in the last couple of easing cycles, Cameron, you can see that they've cut by at least 200 basis points. That happened in 2019. We had 500 basis points of cuts during the Great Financial Crisis, so on and so forth. You know, you're a ballet dancer before. I want to make this analogy. It doesn't look like this is the this is like intermission. That's what that looks like. It doesn't look like this is the end of the entire act here. I don't know. Maybe I'm misinterpreting this.
Well, there are a couple one-act ballets, and there was a one-act ballet back in 1996, 1995, where the Fed cut interest rates declines by 75 basis points. We didn't have a recession, and the economy continued to remain very robust. They then cut interest rates in 1998 again, and that created a really interesting dynamic because by the time that they finished the interest rate cuts in the third quarter of 1998, the NASDAQ was, to use a term that the kids use, mooning. It was going absolutely straight up, meaning that you saw this speculative fervor that was ignited by these interest rate cuts in 1998. So it's always good to remember that there are two different kinds of cutting cycles: cutting because you can and cutting because you should. If you're cutting because you can, 75 basis points has been what they've done in 95, 98, and 2019. Cutting because you should is COVID, the Great Financial Crisis, 2000, the savings and loan crisis in the early 90s. So the debate in all of this over the last 2 years is the Fed cutting because they can or should? Recalibration is cutting because you can. If they stop here, it means that you're not seeing weakness in the employment market. If they don't stop here, it means we're having a recession and you're seeing weakness within employment, and they're cutting because they should.
That was my next question. Barring 1996, the one act ballet that you referenced, the last three cuts were cutting into a recession. Is that what's happening this time? I'm going to pull up one of your charts from your Monday slide deck here. The rise of GDP growth revisions. the blue line here is for 2025, and expectations for GDP growth have been rising over the last couple of months, and it doesn't look like we're getting a recession according to expectations. So they're cutting into, they're cutting because they can, not because they should, is what that looks like. Anyway, I'll let you interpret this.
Yeah, so we're still not calling for a recession. We haven't made a recession call in the past 2 years. One of the
Hmm.
key reasons we didn't is because of that balance sheet dynamic where we didn't think that Fed rate hikes were going to be as restrictive to growth this cycle as they were in the past cycles. But we're still not seeing signs that the US economy is falling off a cliff. Now, it's an important point to note that the starting point for today's growth expectations is far higher than it was back in 2020, at the beginning of 24. We started 24 with growth only expected to be 1% for the year, and then it ended up delivering close to 2.7% or possibly even higher, which that raise in estimates over the course of the year was so powerful for risk assets. And one of the reasons why we just kept seeing equities keep on keeping on. So when we look at the 2025 cohort of estimates, what we have to focus on first is household consumption. We talked about the consumer being sensitive to the wealth effect. We actually think the one thing that could get the high income consumer to pull back on spending is
Hmm.
an equity market correction. It would be an interesting feedback loop where equities would pull back. You all of a
Yeah.
sudden have high income households that have been living high on the hog with these soaring equity markets start to pull back. That then cascades into weaker earnings, weaker equity markets, and maybe that's how this plays out. But then we have to think about things like private investment. That private investment line is sensitive to interest rates. If interest rates stay higher for longer, you're probably not going to see a lot of housing investment. Think about government. Government had 3.3% growth in 2024, which just means that if you go down an austerity path, that could be a source of downside to GDP estimates. And then the last one is exports. Exports are likely going to take it on the chin if the dollar continues to remain high. Also, don't forget about the dollar when it comes to earnings estimates. We wouldn't be surprised if company management teams starting next week when earnings really kick off start to talk down their 2025 estimates just because of the strong dollar.
I'm going to get to the dollar in just a minute. You have a good chart about that. But here is an interesting chart showing expectations for where equity markets are going to go. Is this a leading indicator or a contrarian indicator? Because if everybody were, not everybody, but if an overwhelming percentage of people per the survey, conference board survey, are expecting the stock market to be high in the next 12 months, I mean, that could mean either we're in a topping phase or stocks are actually about to go up. Which is it?
It usually is a contrarian indicator,
Okay.
and that we have to know when we're all on the same side of the boat and we all agree on what is going to happen. And what we find is that typically sentiment measures are most helpful at lows versus highs. They tend to get washed out very quickly at market lows, and you can be a buyer when they hit extreme levels, and you are typically pretty close to the ultimate low. At highs, it's a little bit more difficult. Sentiment can persist at very high levels. It can also start to drift lower, like it did in 2021. If you look in 2021 on that chart, if you look closely, sentiment really wasn't that extended based on this measure. But if you looked at other measures like margin loan balances, leveraged ETF buying, option activity, overall household allocations to equities, all of those suggested that people had quite literally pushed all the chips in and said, I'm all in and I believe in the future and I believe in upside. And all that means is that there just isn't an incremental buyer, and it's a lot harder to surprise to the upside. So a key risk for us in 25 is that we all are on the same side of the boat. We all agree there's only two forecasters on the sell side that are forecasting a down year for the S&P 500 in 2025, which just means that nobody is contemplating that that could actually happen in this environment. We think that this year is going to look like 2015 or 2018. Effectively, you have an economy that, might have some puts and takes to it, but it's still okay. but the equity market just sideways chops through the year, which means that at some point you're up 10%, at another point you're down 10%, and the real challenge is what you do in response to those opportunities, because we do think that given high valuations, stretch sentiment, stretch positioning, all suggests that you kind of have to grow into this. The caveat to that is that we do see a 25% or so probability that we go into a bubble and that we go into a full risk on runaway, kind of like 1998 with the Fed cuts that sparked the late stages of the Nasdaq bubble. So we don't rule that out as a possibility, but our base case is sideways chop.
Okay, so here is the S&P 500, and if you look at 2015, sideways chop here, 2018, sideways chop there. What do you do when the markets are just, you know, trading range bound? Where do you go for yield, Cameron?
Mhm. Well, the first thing is that you have to take a mindset that volatility creates opportunity. You know, when in December of 2018, for those that were in the market, I'll never forget the Christmas Eve when markets were absolutely in free fall because of comments from the Fed, and it ended up being an incredible buying opportunity. And looked around at stocks that we'd been wanting to buy for a really long time, but just were expensive based on our metrics at that time. And it was a fantastic time to back up the truck. So I think having a mindset of creating your shopping list of if this were to happen, what would I do is a really good one. It's you don't want to try to create a plan while you're in the midst of a storm. The other thing that's interesting is usually in those years you do see some kind of leadership rotation that happens. When we think about the growth versus value leadership rotation, we see potential for value to have a snapback and outperformance over a shorter period of time now to start the year because it underperforms so much in December. But we do think that you have to see it be supported by earnings in order to see that relative performance start to be more sustained. Which, if you look at the growth versus value earnings, growth earnings have continued to be revised higher, value earnings lower, which is why we get these short-term snapback rallies in value, but they just can't be sustained. So we're willing to play that snapback, but we're not willing to choose that as our long-run horse for 2025, just because the earnings don't necessarily support it yet, but we're on
Okay,
the lookout for that.
well, let's drill a little bit deeper into allocation now. Here's a chart showing the S&P versus the Russell, and over the last year, and actually the story persisted over the last 5 years, just continuous outperformance of the large caps. Is that going to continue into 2025, you think?
It all depends on earnings.
Hmm.
And the startling thing, even from the Mag 7 versus the average stock, is that over the last 2 years, the Mag 7 has grown earnings by 125%. The equal weight S&P 500, the average stock, has grown earnings by a mere 9% in the last 2 years. So no wonder you had this ultra concentrated market because earnings were ultra concentrated. So in order for small caps to do better, they're not trading at cheap valuations. We don't know that they necessarily deserve the benefit of the doubt when it comes to an earnings recovery. Mostly if yields start to stay higher, we've seen a lot of flows chasing into small caps, mostly post the election. They almost got as high, ETF flows almost got as high as they did back in 2021 in that meme stock craze that we had at the beginning of that year. So we would be cautious on going straight small cap in without the evidence of earnings. We do like mid cap. We do think that quality mid cap is a very interesting place to be because it has a little bit of a value tilt just from the valuation discipline, but typically has better quality companies with better balance sheets, higher levels of profitability. And so, leaning a little bit less away from the ultra concentrated large cap indices into some of those quality mid caps starts to become a bit more compelling, just because we think that there's more opportunity compared to where the starting point of valuations are for the large cap growth part of things.
Yeah, this table here that you've got in your presentation, summarizes your findings quite well. Anything surprised you about the performance by style over the last couple of years that you've, compiled this here?
I mean, I don't think it's necessarily surprising, but I do think it's just notable about how abysmal small cap returns have been. And it's interesting in the context of usually coming out of big market lows, small caps have tended to lead, but it
Mm.
speaks to the uniqueness of the big market low of 2023 into 2024, that this bull market has actually been characterized by rising yields, where in the prior bull markets that we were in coming out of market lows, yields had been falling because of that 40-year bull market in bonds. So, I think that it is notable. I mean, if you look at the compound returns annualized since 2020 in the very bottom line, just how incredible the returns have been out of large cap growth. A
Yeah.
lot of that is because of earnings, and it's been a winners take all kind of earnings environment. So I don't know if you start to see earnings for everything else start to recover in a more meaningful way. If
Yeah.
they were going to do, they would have done it in a year where GDP growth was much stronger, like the last 2 years that we've had. So this whole notion of and hope for the broadening out trade, I can see why people would want to believe in that, but I do think it has to come with that earning support. Otherwise, you'll see these snapback rallies, just like you saw equal weight snapback really strong in July timeframe, and then give it all back up.
You see, what I'm wondering is whether or not there is a broader investment paradigm shift going on here. You see, because back when I was in business school many years ago, we were taught that when there is a bull market, or if you're expecting a bull market, it's reasonable to be heavily overweight in high beta positions, meaning small caps. But that just in the last 2 years was not an effective strategy. Are we rewriting the textbook right now?
I think in some ways this cycle, has that uniqueness of the higher interest rates, and that the small cap index with its interest rate sensitivity has made it so it hasn't been able to participate as much, because you're exactly right. Usually in a bull market, put beta on, risk on, and that just didn't materialize. I think the other thing we have to rewrite is these forecasts for returns, not just for small caps, which have underperformed versus those 10-year forecasts that you see in a lot of capital market assumptions, is what they're called, but certainly for emerging markets. I mean, if you look back over the last 10 years, emerging market forecasts were for double plus the kinds of returns you were going to get in the US with double the volatility. You ended up getting a fraction of the return in the US with double the volatility. So from a
Mhm.
portfolio construction standpoint, it's been an absolute misfire because they haven't provided any diversification. They've added to volatility and added nothing to return. So I think that there's certainly rethinks that need to happen. The question is, it's always these famous last words. Just when you change your methodology and say, oh no, diversification doesn't work, and go all in, that's likely the precise moment that you throw in the towel, that it actually starts to work. And it always is something that keeps me up at night.
Yeah. What else keeps you up at night in terms of risk? We'll finish off risk and then we'll talk about the dollar. You mentioned that potentially we have, a slowing equities market, sparking slowing consumer spending. Any shocks that you're looking out for the
Yeah.
economy, geopolitically, politically? What's going on here?
Watch oil prices. Oil
Hmm.
prices have been down on a year-over-year basis consistently for the last 2 years, meaning that consumers have effectively been enjoying a persistent tax cut and allowing them to
Hmm.
consume in other places. If oil prices were
Yeah.
starting to rise in a more
Yeah.
meaningful way, you do run risk that things like real wage growth, wages after inflation, start to look worse, pulling back on household consumption. Thus, you get lower GDP. Thus, you get cuts to earnings estimates. Thus, you get an equity market correction that is led by both earnings and a deflation of the multiple. That is a wild card for us in 2025. We also think wild cards are stickier inflation that could come from immigration or tariffs. We're not certain, how much tax reform is going to be able to get through, in addition to just the $5 trillion of tax extensions that have to get negotiated and passed. But maybe there's some alchemy that they can do to make those happen. Geopolitical risks have not filtered their way into oil prices like many people thought that they would over the last 2 years. But the wild card would be what if it happens this time, where certain tensions start to filter their way into commodity prices that are more felt by the economy. So the last part of it is just liquidity, and knowing that liquidity has been a big support for the overall market over the last 2 years. You've seen this reverse repo drawdown. You've seen the ability for the Treasury to issue lots of bills. Do you start to see an environment where liquidity isn't as supportive of markets as it has been? I think that Bessent and the new Treasury will do everything that they can to keep liquidity supportive, which just means that even though Bessent said we don't like to do all this short-term bill issuance, I have a feeling he will, simply because they don't really have another choice, because I think long bond yields would not like an increase in coupon issuance. So all of these things are wild cards that we think are potential surprises for 25.
And the Trump dollar trade, is that persisting throughout 2025? Here's your
Yeah,
dollar
we're
chart.
start we're starting to raise our eyebrows a little bit at positioning. This is showing you international money market positioning, IMM positioning. There's another way to measure it with CFTC data, which does not look as stretched, but just like we were talking about with equity markets, when everyone's long, it usually is a top, and when everyone's short, it's usually a bottom. The same thing goes for the dollar. What you can see is that tops in the dollar have coincided with stretched dollar positioning. Bottoms in the dollar have coincided with very light dollar positioning or short dollar positioning. This shows you that positioning is pretty stretched. CFTC, as I mentioned before, not as stretched. But watch those two things, because if the narrative might be the dollar is going to be stronger forever, but if everybody's already positioned that way, it could reverse in the other direction.
Okay. Bottom line then, your top asset classes for 2025, more overweight stocks, bonds, or something else.
Yeah, so we're neutral equities. We are neutral fixed income. We are underweight high yield. We just think you're not getting compensated for the risk given where spreads are. We are overweight alternative assets, and we do like things that we consider uncorrelated to equity markets that look a little bit more interesting. So it includes things like infrastructure that's very correlated. It can be correlated to the economic cycle, but less correlated to equity markets. We find opportunity within equities in more value leaning, dividend quality kinds of parts of the market. We do quality overlays for everything. So we tend to focus on things trading at a discount to the overall market. And that allows us to have that discipline that if we do see a derating, there's just less air to come out of those multiples.
Note on your neutral bonds outlook here. This is the 10-year. Are you also expecting the 10-year to chop sideways then going into 2025?
Yeah, we think that wide range is likely. We are not ruling out a move above 5%. If you were to see an increase in coupon issuance, for example. But we think at some point over the course of 2025, we're going to get growth fears, and those growth fears are going to materialize in a movement lower in yields, which is why we say, look, if you need to extending duration into a period when bonds are selling off and yields are spiking seems to make a lot of sense. Exercise patience when everybody's afraid, and piling into bonds when yields are low.
Perfect. Thanks very much, Cameron. Excellent analysis as always. Where can we learn more from you and Newedge Wealth?
You can go to newedgewealth.com. I'm on X at Cameron Dawson. I'm on LinkedIn as well, where I post everything. You can sign up for the distribution list, and happy to chat.
Yeah, make sure to follow Cameron. Links down below. Appreciate it. Maybe next time we'll call you Dawson to make you realize your dreams. No.
I'm cool for once.
Yeah, no, you're always cool, no matter what your name is. Thank you very much. Happy New Year again. We'll speak soon.
Happy New Year.
And thank you for watching. Don't forget to like and subscribe.